You know what? A lot of the guests that I have on my show and a lot of the guests that I see on my peers' shows are calling for runaway inflation. And it's really easy as a consumer to understand why that would be, because when a consumer good increases in price, we feel that immediately in our wallet. But obviously that doesn't translate into runaway inflation. I know you're one of the more outspoken voices opposed to that. So I'd love you to share some light on what you're seeing and why that idea is wrong.
Well, there's no question that we currently have inflation. That's really indisputable. The issue is whether these forces are going to be sustained. And it's our strong opinion that we're in the vicinity of the peak growth and inflation for the year. And that the growth and inflation that we're seeing right now will be the highest for a long time to come. This is the best that we get right now. The pattern will change very significantly as we go forward. By the end of the year, before the end of the year, I think it should be readily apparent that the level of economic activity is going to be considerably below where the pre-pandemic trend that was in place as we entered 2020 would have taken us. And I think that the price pressures that we've seen today are basically due to supply side disruptions, which are transitory. They do not persist. They can be vicious, as these are, but they do not persist. And in addition to that, the benefit from huge debt financed fiscal packages do provide a transitory benefit to the economy. And so what happened was the supply curve shifted inward, and the demand curve shifted outward. That gives you higher prices and somewhat better growth. But the move in inflation was quite significant. But that will change. The pandemic greatly disrupted production processes in the United States worldwide. And as a result, the flow of goods into the United States was tremendously disrupted. And this afforded the relatively higher cost producers in the United States an opportunity to grab market share. And they were able to grab market share by raising prices at the same time as a lack of competition. But as the pandemic problems abate and we begin to get a greater flow of goods into the United States, the picture will change, because the low-cost producers in Asia who have lost market share are going to want to regain market share. And the high-cost producers in the United States who've been benefited are going to want to hold. And that suggests we're going to see price wars. And the picture will change. The pandemic did far more to boost domestic output than the Trump tariffs of a few years ago. It was universally helpful to domestic producers in many, many different industries. And so that picture will definitely change as we go forward. And the other thing that will be happening on the supply side, it's really the adverse supply situation has actually raised ordering and demand by more than the fundamentals warrant. Because people are frustrated. They cannot get needed product.
Mm-hmm.
So what do? They place a second order or a third order. And as these disallocations and bottlenecks and shortages come to an end, folks will start canceling the superfluous orders. And that will be occurring at about the same time that the transitory benefit from the huge sum of borrowed funds begins to lose its potency. There's probably more than 30 cases of debt financed fiscal operations in Japan. Give you a book up. That's it. There's 20 cases in Europe, maybe 25. Take the Trump tax cuts of 2018, debt finance. Second quarter of 2018, no question about it, great quarter, right? But what happened in the third quarter? It was okay, but the growth started decelerating. And then all the way through 29, growth was irregularly getting weaker and weaker, even though the Fed was constantly cutting rates.
Mm-hmm.
And the pattern of the economy going into 2020 was quite poor. In fact, in 2019, the world experienced the first contraction in global trade for a non-recessionary year. And so these packages, although they're huge, they don't last in terms of their benefit. But what does last is the debt. And the debt's a problem. The debt triggers the law of diminishing returns. If you increase a factor of production, such as debt capital, initially output rises. Continue overusing it, output flattens out. You still overuse it, output declines. And it's really difficult for a lot of practical people to come to grips with the fact that this is a nonlinear relationship.
Right.
People assume that economics is accounting, it's business. Well, no, it's not. If I told you I were a physicist and you had to be prepared to grapple with nonlinearities, you might say, oh, well, I don't like it, but I can understand. Or if I were an engineer or an architect. And so the excessive use of debt triggers diminishing returns. And so you get weaker and weaker. And you perpetuate the problems. You get a short-term benefit, and then the benefit flows away. And it flows away very quickly. And that's basically where we are.